In this lesson, we'll be looking at primary markets. So there are two categories in the stock market. One is primary and the other is secondary market. So secondary market is completely about trading the stocks, buying and selling them with the help of exchange. Whereas in the primary market, you try to invest in the market. So you'll be putting in money and you will be allotted some sort of shares. Now, within the primary market, there is a process called initial public offer, through which the company, a private limited company, will go public, and normal people like you and me will get to invest in that particular company. And based on the amount that you invest in the company, you will be allotted certain shares. So let's go through it. So first question that needs to be answered is, why does a company even issue shares? So before answering this question, you need to know certain steps are involved for raising funds to run that particular company. So let's say you have an idea, a business idea, and you may not have sufficient funds to establish a company and run it. So what happens is you'll be sharing it along with your friends and family, and the first person who is going to invest just based on the idea without the company having any track record, and if someone invests their money into the company, they'll be called as angel investors. So after these angel investors invest their money, then in the second stage, when the company starts its operation full-fledged and the revenue comes in, there's a positive cash flow, then comes the venture capitalist. So he'll be in the second stage. Now third stage funding is raising any loan from the banker. So this is done to improve their expenditure, to improve the overall business, and the expenditure here would be called as capital expenditure, or the short form it is capex. So this is purely going to be a loan and they need to pay interest against this. So first angel investors, then the venture capitalist, and now came the bank. In the next stage comes the private equity. So this is the fourth stage now. And when the company picks up, now it is generating huge revenues, huge profits. Now whoever has invested in the company, they want to liquidate their shares or at least reduce their part, so that they get a return on their investment. Now to liquidate their shares, they can sell them to the public, either company from its own share, or the investors who have invested in the company, either of them, they can liquidate their shares, and doing this is called as initial public offer. So IPO is what? It is selling the securities to the public in the primary market. And since this is a fresh issue of securities, before this public investment was not accessible, and since this is a fresh issue of securities to the public, initial public offer name has given to this. So the word initial has come only because of that. Now within this IPO process, you get to hear some sort of words. First is price band and fixed band IPO. Price band and fixed band refers to at what price the shares must be issued to the general public. So the company may decide that there should be a fixed price, and people will get to buy those shares at their particular price, or they'll be giving you a price band, so lower end of the price and higher end of the price, and you need to bid. So you need to offer bid to that company that you are ready to buy at certain price. So if there is an overwhelming response for that particular IPO, only people who have bid higher, so that means if they are on the upper side of the price band, they'll be getting the shares. So based on the response that you expect from that particular IPO, you'll, or whatever the value that you see in that company, based on that you will be putting in your price. So price band, it is not fixed, it ranges in between a lower end and the upper end, whereas fixed price, the price is fixed. You can directly buy the shares at that particular price, whatever is stated. Next, when the company files an IPO, it needs to produce a draft document. So in that document, the history of the company, the revenues, the balance sheet, whatever it is doing regarding the process or the company, and regarding the revenue, the profits, who the promoter is he facing any criminal procedures against him, everything A to Z that is related to IPO and the company, promoters, the business, everything will be mentioned in that DRHP. And based on that, after you go through that DRHP, you can make a decision or you can take a call whether to invest your money in that particular IPO or not. So there are crucial details about the company, and the company cannot hide anything regarding the promoters or regarding the business, anything related to the company, they cannot hide from that DRHP. So draft red herring prospectus is its full form. Then under subscription and over subscription. So we recently IRCTC got listed on the exchange. When the IPO of IRCTC came into the market, it was oversubscribed. So whatever the number of shares was released into the market, more than 50 to 60 times it got oversubscribed. So what does this mean? Undersubscribed means if the bids received are less than the number of shares are offered, it is called undersubscription. And if the bids received exceed the number of shares, that is called as oversubscription. Now in case of oversubscription, company has an option that they can allot some more percent. So initially company has allotted some percentage of shares to the public, and they see an overwhelming response, shares have been oversubscribed. Now additional 15% they can again release into the market. That is called as green shoe option. So this happens only when there is an oversubscription in the market. And any company, when it goes to initial public offer, there are certain prerequisites which it needs to satisfy. Only then it will be eligible to get itself listed on the exchange. So for NSE, if a company wants to list itself on NSE, it needs to have a minimum paid up capital of 10 crore. And after the IPO is done and after the exchange gets listed, the market capitalization, it should not be less than 25 crore at any point of time. So here market capitalization means market price of that particular share multiplied by number of shares that are available for trading. That is the market capitalization. And uh, before even thinking of going public, it needs to have at least 3 years of a good track record. So it should be either track record of the applicant or the promoters of that particular company. So without so just when you have an idea, immediately you cannot go public. So you need to maintain at least 3 years of good track record so that investors feel secured. Only when you here you're trying to sell your product. That's it. When you're trying to sell your product, it needs to be used by someone else and they also must be satisfied. So here if the promoter himself is not satisfied with his track record, why would public invest in that? So SEBI very strictly has put this rule that there should be at least be 3 years of good track record. Only then the retail investors like you and me will feel secured. Then within the process of an IPO, first you need to appoint a merchant banker. Then you file the application form for IPO, and you should get a positive nod from SEBI, Securities Exchange Board of India. Then prepare the document, draft red herring prospectus. Then after that, market your IPO so that you can bring awareness amongst people that your IPO is coming into the market and why should they invest in your IPO. Then fix the price band so that the applicants or retail investors, they can come in and bid their prices. And the process of uh, the whole fixing the price band and people bidding it, it is called as book building. And finally the stock gets listed. So merchant banker, the other name for him is book running lead manager. So he underwrites the company shares. Underwriting in the sense he'll be buying all of the IPO shares or some part of it, and he is the person who is in turn selling them to the public. So regarding the other process also, filing the application, getting a nod from SEBI, all in every step, merchant banker will be there. So the company need not do anything. He just needs to hire or appoint an merchant banker, and rest of the things, it's his duty to do that. And then filing the IPO. So the application, it needs to include all the documents, and these documents, it even includes the DRHP. So this DRHP is not only available for public. First it needs to be available for SEBI. So SEBI goes through the DRHP, and if they find any discrepancies, they'll get back to the company, and if everything is okay in the documents and DRHP, they'll give a nod, and then the rest of the process follows. Now details, as I told you, details of the promoters, the company annual reports, all these things also needs to be submitted along with the application, and SEBI will go through them. Now the initial fees would be 50,000, and every year also there will be an annual listing fees. It depends upon the paid up share capital of the company. Then the marketing goes, so it can be road shows or it can be paper advertisement, visual ads, anything, so that it brings an awareness amongst the people. And then the price band, either the company, it's up to the company to issue a fixed price or a price band. And time the time period through which the retail investors can apply for the IPO, it's around 3 days. And finally the listing day. So the company begins trading on the stock exchange at a listed price. After that, whatever price is there in the market, that is because of the secondary market. So people who have got the shares, they might again try to sell it to someone else. So the process follows depending upon the supply and demand of that particular company. So this is regarding the primary market, and we have gone through initial public offer, and whatever steps are involved in that, we have watched all of them.